It is earnings season, and we are looking at the numbers this morning, not just to tell us how our locally listed companies are doing, but how we're doing as a whole. We've got DEWA numbers and Spinneys numbers, which are a great population proxy, and ADNOC Logistics and Services, which, as someone who moves energy around the place, tells us quite a lot about how the world is feeling in general at the moment. Very pleased to be joined to discuss their Q1 numbers by the CFO, Nick Gleeson. Morning, Nick.
Good morning, Brandy. Thanks for having me on.
So, a little bit of a mystery for me this morning. You've got revenue up by just over 40%. EBITDA, so your operating profit, is up 20%, but your net profit is down 5%. Why the divergence?
So it's an accounting implication. So we completed at the beginning of this year the acquisition of Navigate, a huge international platform of commercial pooling with tankers. The acquisition was so positive that we had a bargain gain on acquisition. That means that the valuation of the company by the time we completed the acquisition was higher than what we paid for it. And we have to depreciate that difference over time. So it's a non-cash item that drags our net profit down a little bit this year. But in cash terms, we're just delivering more than ever, and we've grown enormously, as you can see through the EBITDA line, up 20% on EBITDA to $344 million for the quarter.
You do, though, mention lower commercial shipping rates. Why is this? Is it a problem, and how long is it likely to be the case?
We'd prefer they weren't as weak as they were in the first quarter, but we already see a pretty strong return on the tankers side. So essentially, we've seen weakness in LNG carriers, in tankers, and in dry bulk. But the way that we've built our platform is very resilient. So we have a lot of long-term contracted activity and a lot of strong profitable activity in integrated logistics. So compared to other shipping companies, we're doing extremely well.
Talk to me about cash flow, though. The other red arrow I saw there, cash flow from operations down around 13%. What does that mean for your plans to buy and do stuff, your capital allocation plans?
So even though cash flow from operations is down a little bit, and the two drivers there are basically the relative weakness in shipping rates, but also increase in working capital related to some of the larger projects we're completing now. Our free cash flows are up 29% year on year to over $200 million. And that's after we've invested over $150 million in growth CapEx. So our cash flows are still extremely strong. We've got a really strong balance sheet, less than 1x net debt to EBITDA. Beyond what we've already committed to invest, we've got about $3 billion of extra financial capacity over the next few years. So we're in extremely good shape from a cash perspective.
Okay, well, a couple of questions about what your earnings tell us about what's going on in the world. You talk quite a bit about the deployment of AI tools like SmartPod. Are those technologies paying off? Like, can you put a number on it, a figure on it? Are they saving you money? Are they making you money?
It's early days. We certainly expect they're going to make us a lot of money. If you take, for example, the logistics optimization that we're investing in at the moment on our integrated logistics services platform, we definitely see reductions in fuel consumption. We see reductions in the number of vessels required to move cargoes coming through that platform as well. We've seen an increase in the number of vessels significantly below the increase in the tonnage which is moving. So we are realizing savings, but the long-term savings are what we're really after. That AI will kick in over a period of time and deliver serious savings to us. You'll also notice that with the additional depreciation this year, $54 million, we've actually committed to maintain our guidance even after that. So you can see we're improving our net income margins over time as well. And a good part of that is driven by the AI investments we're making.
Yeah, look, your guidance is still strong, which is interesting because we are seeing one of the themes of the US earnings season is that people are just not wanting to put any forward guidance out there or retracting previous guidance. Given what you do for a living, moving stuff around, moving energy around, and given that we've got weaker energy prices, we've got a trade war, we've got an uncertainty around the US and Chinese economies, how can you be that confident about your forward projections?
It's a great question. And the platform we've built is all around resilience. We're working very hard to make sure that we've got a high proportion of long-term contracted income. At the end of last year, we had $25 billion, in fact, more than $25 billion of forward contracted income going all the way out to 2048. So we've built a platform which is really resilient against market weakness. And in the past year, we added 340 years of additional contracted activity, and none of that has kicked in yet. So the resilience we had in Q1 is before we add those contracts to the books.
Are you, though, exposed to slower trade and therefore less energy consumption? Is there a potential weakness, a potential headwind there for you?
We're definitely exposed, and that's what you've seen in Q1 is the impact of that type of exposure on us. When we see weaker rates in tankers, dry bulk, and LNG carriers at the same time, you've seen the outcome of that in our Q1 results. The good news is because we've got a diversified earnings portfolio, we're protected to an extent by what's happening in our integrated logistics activity and, again, those long-term contracts that we have. So we definitely have exposures, but we've built ourselves to be very resilient to those exposures.
Nick Gleeson is the CFO of ADNOC Logistics and Services, ADNOC L&S, listed company reporting its Q1 numbers. Thank you very much for your time this morning.